The stock market has been extremely insane lately, with Jerome Powell's Jackson Hole comments causing equities to tumble, among other economic concerns. Now is a terrible moment to invest since the markets might continue to plummet. My investment strategy is to purchase and keep for a long time. So in this video, I'll go over 7 great stocks to consider buying this September 2022. I'll talk through major news and why I believe they're good long-term investments. The very first stock we're buying is Tesla stock, ticker TSLA. Tesla is a native of American Global Auto and Technology Corporation specialized in electric vehicle production. Tesla stock is currently trading at $291.35 per share. If we examine the 1-year price chart, we can see that this stock has had some pretty huge swings. We achieved 3 highs in November, January, and April of this year, although we did have a very huge drop back in May, followed by a pretty nice rebound till now. Tesla has a market capitalization of $913 billion, a PE ratio of $104.54, and earnings per share of $2.79. If we check at their valuation measurements, we can see that they have a 5-year projected PEG ratio of 1.42 and a PB ratio of 25.81, as well as a profit margin of 14.17% and a return equity of 29.89%, which is extremely strong. They've seen sales of $67.17 billion in the previous year, and according to their balance sheet, the company has total cash of $18.92 billion as well as a current ratio of 1.43. Tesla stock has been substantially cheaper since Thursday, owing to a 3-for-1 stock split just after closing bell on Wednesday. This is helpful for individual investors as it is now much easier to invest in one share of the stock. Meanwhile, investors who have held onto stock for a long period will still have the same value in the firm. They will only have 3 times as many shares, each at a reduced price. The Tesla stock split is a really good news because it shows how well the company is doing. For shares to be so expensive per share that it needs to lower the stock price to attract more investors is a great sign. And Tesla, as the innovator in EV manufacturing, has sent shockwaves throughout the auto industry. Tesla has become the face and image of the vehicle market. The company's revenues climbed by around 42% year over year to $16.9 billion, while gross profits increased by approximately 47% year over year to $4.2 billion. There are several reasons to predict more expansion, but the most important is the introduction of additional EV battery production in the United States. Panasonic, in particular, is planning another large-scale U.S. battery cell facility, which might augur well for EV companies, particularly Tesla, which has long relied on China's production and export of EV batteries. Having additional EV battery production in America will potentially reduce prices, boost convenience, improve logistics, and attract more business into the U.S., which would be a tremendous advantage from Tesla's technology. That's why it's on my list of best stocks. The next stock we'll be discussing is VOO for Vanguard S&P 500 Index Fund. This is not a single firm, but rather an ETF that contains the top 500 companies in the United States. And if you purchase any company on this list, it should be VOO in my view. I keep the largest portion of my money in exchange-traded funds or ETFs, such as VOO, and strive to invest just 10 to 25% of my money in individual stocks. So 1 share of VOO is currently trading at $365.86, with a 52-week low of $334.24 and a 52-week high of $441.26. Here's a one-year price chart of VOO. You can see that a year ago, it was trading over $400 and experienced a pretty huge fallback in January and February of this year 2022, followed by a minor rebound, another major plunge, and it has recovered a good amount since then. However, as you check at the 5-year chart, you can see how much VOO has increased over time. So the net assets in this ETF are around $780 billion. The average PE ratio is 13.08, with a dividend yield of 1.49, and it's really down around 11 year-to-date due to a variety of variables. VOO is classified as a big blend ETF, and the best part is that the expense ratio is only 0.03%, which means that perhaps the fees you're paying to hold this ETF are effectively zero, making it one of the greatest ETFs you can buy if you're bullish on the American economy. Overall, I believe that ETFs like VOO are the greatest option for most investors to own. If you do want to choose particular companies, try to limit it to a smaller portion of your portfolio and rather invest for such long-term ETFs like this and forget it. This is a much easier approach to invest, and many people believe it is the ideal plan for long-term investment. The Apple stock, ticker AAPL, is third on our list. Apple is a global technology firm best known for its smartphones, tablets, laptops, and operating systems. The price chart shows that it's been somewhat erratic, but in recent months, we've witnessed a tremendous comeback in Apple's share price. With a market valuation of $2.513 trillion, Apple has a PE ratio of 25.84, earnings per share of 6.05, and a dividend of 0.58%. They have a 5-year expected PEG ratio of 2.83 and a PB ratio of 43.52 with a profit margin of 25.71%, a return equity of 162.82%, a total cash of $48.23 billion, and a current ratio of 0.87. Their dividend payout ratio is 14.7%, which is perfectly healthy. Apple revealed its third quarter profits for the fiscal year 2022 a month ago, announcing a record sales figure of $83 billion, up 2% year over year, and quarterly earnings per diluted share of $1.20. This insanely high profit margin, along with the fact that Apple continues to shatter its own records, demonstrates how dominating this tech corporation has become. If we check at the tech giant's consolidated financial statement, we see nothing but growth. Apple isn't here to stay. It exists to dominate and prosper. And for me, the most exciting part isn't how much more money the firm made. It's about how well the company has grown in terms of subscriptions. During the same earnings statement, Apple said it has over 860 million subscriptions throughout all of its services, a 160 million increase year over year. This is where the true growth is, because these 860 million subscribers will provide a consistent but massive stream of revenue for the tech giant over time, and all these subscriptions could be leveraged into other services the company offers. Apple is still the most valuable business in the world in terms of market capitalization, and I believe that AAPI is a no-brainer investment for the long term due to its durability, dependability, reputation, and popularity, which is why I put it on this list. Let me know in the comments if you have any other questions about investing. Let's return to the video. Walmart, ticker WMT, is the fourth stock on the list. Walmart is a global retail firm based in the United States that operates inexpensive department shops, hypermarkets, and grocery stores all over the world. Walmart is now trading at $136.71, with a 52-week low of $117.27 and a 52-week high of $160.77. Here is a pricing chart for Walmart over the previous year. You can see that prices were quite stable in the later part of last year, as well as the first few months of this year. But we witnessed a significant drop in prices in May 2022 and have since seen a minor recovery. Walmart has a market capitalization of $370.725 billion, a PE ratio of 27.32, earnings per share of $5, and a dividend yield of 1.62%. We have a 5-year projected PEG ratio of 3.92, a current profit margin of 2.36%, and a return of equity of 16.20%. $13.92 billion in cash, and a current ratio of 0.84. Their dividend payout ratio is 44.40%, which is still respectable. So obviously, inflation is an issue right now, since items are becoming more costly, and as a result, spending will definitely fall. As a result, although many retailers reduced their profit estimates owing to excess inventory, Walmart did not. Walmart, the largest retailer in the United States, has handled the problem like a champ by exploiting this inflationary moment as an opportunity for Walmart users to get even more savings via Walmart Rewards. Despite the uncertain economic circumstances, Walmart is constantly building new facilities and growing its retail network. Most recently, Walmart completed its largest facility in Pennsylvania, a 1.8 million square foot distribution center. The firm intends to establish other facilities in the state, including a consolidation center, so the expansion will not stop there. Walmart released its earnings for the second quarter of the fiscal year 2023 earlier this month, with total revenue increasing 8.4% to $152.9 billion, and the company experiencing growth in same-store sales for Walmart and Sam's Club stores, as well as its e-commerce platforms and global facilities. Of course, there has been a significant drop in Walmart pricing recently, but in my opinion, this only makes it a better opportunity to invest, especially if you're holding for the long term. Following that is the Procter & Gamble, ticker PG. Currently, one share of Procter & Gamble is trading at $139.57, with a 52-week low of $129.50, and a 52-week high of $165.35. And here is a 1-year price chart showing that they were trading at approximately the same price a year ago. So a pretty substantial spike in price to over $160, and plummeting in March of 2022, Bounce Up witnessed additional huge drops in May and June this year. Since then, it has recovered somewhat. It now has a market capitalization of $332 billion, a PE ratio of 24.02, earnings per share of $5.81, and a dividend yield of 2.62%. They have a 5-year projected PEG ratio of 4.43, a PB ratio of 7.30, an 18.38% current profit margin, and a good return equity of 31.64%. This is based on $80.19 billion in sales during the previous 12 months, $7.21 billion in cash, and a current ratio of 0.65. So because the market is now in an uncertain state, investors are more likely to favor more stable stocks over riskier growth businesses. A corporation as huge and as sturdy as Procter & Gamble with a track record of consistent and exceptional revenue growth, is unquestionably a stock that you should consider. But first, let's simply look at the earnings figures for this company. At the end of the previous month, Procter & Gamble reported a year-over-year net income growth from $2.91 billion to $3.05 billion. A significant increase in profits and an uptrend indicator of Procter & Gamble's current viability. However, the corporation also reported that higher product price compensated for a drop in sales volume owing to COVID pandemic-related lockdowns in China and reduced operations in Russia. This tells me many things. The first is that Procter & Gamble is modestly losing sales owing to external circumstances outside its control. The second point is that the company's products remain so essential that a price increase may offset a drop in total sales. This is a wonderful way to picture the firm's resilience. And of course, they still pay great dividends, which is another huge benefit. While this is a very dull company right now, it's not really hot or interesting, which is why I think it might be a terrific investment since it does fly under the radar. As previously said, Procter & Gamble focuses a higher emphasis on value accumulation instead of hazardous growth. Its durability and longevity testify to its value as a stock worth keeping an eye on. Next up is the stock ticker BAC for Bank of America. This is a worldwide investment bank and financial services corporation based in the United States that primarily focuses on commercial banking, wealth management, and investment banking. So one share of BAC is currently trading at $34.33, with a 52-week low of $29.67 and a high of $50.11. Here's a pricing chart for the previous year. You can see that there were some significant price drops, indicating that now may be a good time to invest in the company. They have a market capitalization of $275.68 billion, a PE ratio of 10.72, earnings per share of 3.20, and a dividend yield of 2.5%. With revenues of $91.3 billion in the previous 2 months, they have a profit margin of 30.69% and a return on equity of 10.26%. They have a total cash balance of around $714.18 billion. Banks will bear the full impact of the pain in a market where the Fed continues to tighten its grip on consumer spending. Banks are places where individuals may borrow money to spend and then repay it with interest. This is why we have seen BAC decline by a big margin for the last year. But there are lots of reasons why Bank of America remains a positive selection for beginners. Bank of America isn't the only one struggling. Big competitors such as JP Morgan Chase, Wells Fargo, and Citigroup have all suffered massive losses in the last year. While the value of the firm is declining, several things are taking place to prevent Bank of America from losing a tremendously large amount of money for the company. The bank is reaching out to other influencers in novel ways to boost revenue, such as collaborating with Grubhub to provide Grubhub Plus to its cardholders. The bank understands how to stabilize its operations through sluggish periods, which is quite encouraging to me as an investor. I also believe that BAC is now trading at a discount because it is one of the industry's main companies. Overall, I believe this is a good long-term investment for long-term investors, which is why I placed it on my list. Cisco is the final stock, ticker CSCO. Cisco Systems is a global technology firm based in the United States that specializes in network hardware, software, telephony, and other high-tech goods and services. Cisco is now trading at $44.80 per share with a 52-week low of $40.82 and a high of $64.29. Here's the 1-year price chart, and you can see that a year ago, we were trading at close to $60 a share. Since then, we've seen a fairly slow decline with a strong loss in May of this year, and we've seen a minor recovery. Cisco has a market capitalization of $185.459 billion, a price-to-earnings ratio of 15.88, earnings per share of 2.82 cents, and a current dividend yield of 3.36%. They have a price-to-book ratio of 4.83, a current profit margin of 22.91%, a return equity of 29.15%, a total cash of $19.27 billion, a current ratio of 1.43, and a dividend payout ratio of 53.19%, which is quite good. Cisco recently released profits, and the company's disclosures exceeded Anna's predictions, leading in a 6% increase in CSCO's valuation. The corporation also witnessed a year-over-year increase in sales from $49.8 billion to $51.6 billion, as well as a year-over-year increase in operating income from $12.8 to $14 billion. Cisco is a technology firm that creates useful software and gear for other people to use on their computer to perform activities and projects. Overall, I believe Cisco is a good stock to own because of its dividend payments and the fact that it is a long-lasting and trustworthy company. If you're searching for a safer investment that pays dividends, I strongly suggest conducting some further study on this firm. Anyway, those are my top stock selections for the month of September 2022. As always, do your own research before investing in anything. This video cannot be considered financial advice. I'm only someone on the internet, and what I propose is that you perform at least 1 hour of thorough study before purchasing any stock or investment. You must do your own due diligence about whether to invest your own money. I know it's a risky time to invest right now, particularly with what's been going on in the economy. But try to look at the bigger picture and choose solid companies that are here for the long haul. Or simply invest in ETFs like VOO, and you should see significant gains over the next decade or two. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.